Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by partner and chief market strategist, Chris Verrone. Chris, how are you doing this morning?
I'm doing great, Ross. Thanks for having me.
Yeah, good to talk to you. This will be our last video of the year, so the perfect guest to end 2025 with and then look towards 2026. I want to focus on first something that you've been writing about a lot the last couple of weeks, which has been the rotational market, right? So big tech weakness, but a lot of other stocks picking up the slack. What are you seeing there? And what does that tell you about what we should look forward to in 2026?
Well, first off, Ross, it's great to be here. Thanks for all your great work this year. It's hard to believe there's 9 trading days left in 2025. And as we kind of look ahead to what the market may have in store for 26, I always think it's important to revisit what are some of the clues that the market's been offering to us over the last 6, 7, 8 weeks. And one of the things that's really become evident in our work is this handoff from the more speculative corners of the market to the real economy type stocks. You see it with strength in transports, with retail, with regional banks, financials broadly, discretionary broadly, all the travel stocks have inflected up, the commodities. So I think when you look out to 26, there's a lot of evidence here that if anything, the real economy may be inflecting higher. So we take some comfort with that into next year's outlook.
Yeah, and that pairs nicely with another thing that you've been writing about a lot lately, which is the moves in the yield curve, the long end of the curve kind of percolating higher as the Fed is cutting and the short end is coming down. What are you seeing from the yield curve? What is it telling you about the outlook for stocks? And do you have a yield curve call heading into 2026?
So it's a great question. And, I think when you look back over the last couple of years, what has derailed equity rallies has generally been higher long-term rates. Something north of 440, 450 on 10-year yields has kind of generally been the red line for risk. We sit here in the second to last week of the year, and 10-year yields are still about 415. They've been in the same range that they've been in really all year. They have drifted modestly higher over the last couple of weeks. That has steepened the curve as 2-year yields have fell. But it's kind of the right type of steepening. It's 2-year yields flat to down, which implies a central bank that is on kind of still the easier side of the ledger. At the same time, this very contained mild drift higher on the long end doesn't seem to be stoking any big inflation fears. I think, if anything, when you look at these market signals, this modestly steeper curve, which we're seeing globally here as well, I think supports the idea that the real economy is picking up pace into next year. So I still like curve steeper. I think it comes kind of in the form of 2-year yields on the short end, moving modestly lower, maybe 330, 340. I'd be surprised if we saw much worse than that. And then, 10-year yields stable in this, call it 415 to 430 range. The level I would watch is 450 on 10s. You start to creep above that, you begin to wonder if the red line for risk is being crossed.
Yeah, and you all have pointed that out. Even at various points of this bull market has been a point that causes some volatility and some churn. Let's end by going global. I want to get your outlook on the dollar. We're talking about kind of divergent central banks here. Dollar weakness has been a big story of 2025, as has international outperformance. Do you think that continues? What's your outlook for the dollar, and how does that play out in other asset classes?
Yeah, I do think it continues. But remember, when you look at 2025, most of the dollar weakness actually came in the first 3 months of the year. Dollar was largely range bound or sideways since about April. I do think after about a 6-month pause, the dollar's downtrend is reasserting itself here. And, that's just as much a call on the dollar as it is in the commodity complex. When I see, all these commodities starting to firm and break out, to me, that's more consistent with a weaker dollar environment than a stronger one. A lot of the commodity stocks seem to suggest that as well. And then when you look at the currency market, Aussie dollar firmer, CAD firmer, what do all those economies have in common? Very commodity and resource based. So I think the commodity complex is giving us a signal on dollar here. I would expect the weakening to resume into 2026.
Chris, as always, super insightful. Thank you so much for the time. Happy holidays to you and yours, and we'll look forward to talking again in 2026.
Ross, my pleasure, and I'll talk to you soon.